So thank you very much. Good afternoon, everyone. Thank you for being here. I'm very delighted to moderate this panel, the last panel of the day, and actually the last panel of the conference. Congratulations to the organization. Today, I'm very glad to moderate this panel about finance and tokenization. I'm a French reporter. I'm covering financial and Web3 subjects, and I think that this is one of the biggest topics in 2023. So for this discussion, we have three great panelists with us. So Yacine, Farouk, one of the co-founders of Mimo. In just a few words, so Mimo built its own protocol to tokenize the real-world assets, right? We will talk about it later, but thank you very much, Yacine, to be here. We have also Arnaud, Caudoux, Deputy CEO of BPI France. BPI France is the French investment bank. And correct me if I'm wrong, Arnaud, you invested, BPI France, in almost 100 crypto projects in several years. So you are a big player in France. More than that, yes.
No, more or less.
More or less, okay, perfect. And the third one, Max Boonen, you are the co-founder of PV01, which is a debt capital markets platform, and you are also tokenizing assets, especially bonds, but we're going to talk about it. So Yacine, my first question is for you. How it's working, how you digitalize assets and for who on the market?
So it depends on which angle you're coming from and what you want to do with real-world assets. I would say that in the first phase, most likely it's going to be for treasury, for funds, for VCs, for hedge funds, and for all of these institutions that wants to hedge and wants to manage the treasury in a smarter way than what we've had so far in the crypto ecosystem, in a way that would probably give you like more or less of a guarantee of a backed asset, something that actually exists and something that actually have an intrinsic value.
Yep.
Which is something that we didn't had yet in the ecosystem in the last like 6-7 years.
Yep.
If the idea of that, if we can come and give more or less the guaranteed of a tangible assets in a digital world, that would be probably like a less, how can I say, possibility of a less bigger returns.
Yep.
The possibility of returns would be like less high,
Yep.
but much more smarter and safer in the way that like what people are doing in the traditional like finance model. The idea is that we want to bring people within the ecosystem that are in a headspace where they are like super degen. And even if they are not, like they are, like we think that we are not because we've been in this space for a long time. But the reality is that even for the more conservative of us, compared to like what's happening in a traditional finance, we are super degen. So the idea is to bring something that has like a bit more value, that is a little bit less appealing, but much more smarter when you want to hedge against like a whole wallet or treasury.
And just another question, and it will be the same for you, Max. So now you're working with the crypto space, or are you able to onboard also, traditional finance institutions?
I think you can do both. For us, at the moment, and the product that we are launching, it's more so for people that are already within the crypto ecosystem, that are staying on the side with stable coins, and wants to hedge and wants to do something with the treasury. They don't want to let it sit on the side because effectively with inflation and all the things that is happening with fiat money at the moment, when you have $1 million that is sitting on the side, at the end of the year, effectively you have 920.
Okay.
You're losing like 8 to 9% every year. So the product that we are proposing to the market is effectively like a solution to hedge against inflation, or to just manage a part of your portfolio in a more smarter way that gives you like a little bit of a better guarantee in terms of like what you can do with your portfolio.
Okay. And Max, you announced 2 months ago a little pivot of your business, especially on bonds. I mean, how are you working, and what did you choose? I mean, to be more focused on bonds.
I hope I heard your question right, because I feel like this is Barcelona blockchain week actually.
Yeah.
So it's difficult to think. But I think when you say it's a new business actually, I used to be at B2C2, which is a crypto market maker, and we initially wanted to do something within B2C2, but then ended up doing that outside thanks to our VCs. Instead of talking my business up, I'd just like to explain what the problem is in the crypto market. In the crypto market, up until Celsius, 3 Arrows, there were crisscrossing links of credit between the largest players, Genesis, FTX, B2C2 also, and everyone else. And those credit links were bilateral, opaque, non-transferable. And where we ended up is when Celsius and a couple others failed, it was really unclear who owned those exposures and who actually had borrowed. You know, I think people were surprised when they learned the extent of 3 Arrows Capital's borrowings.
Yeah.
You know, because they went to a couple of players borrowing 100 million here, 100 million there, and soon you're talking real money, right? And everyone was surprised. And that market has completely died now. It's gone. However, the two sides of the market, the lenders and the borrowers, they still exist, still want to borrow, but they lack a product in the middle to do that. And our angle is that we think that whereas crypto has a lot to teach to traditional finance, it cuts both ways. And in this case, there's a very simple product that doesn't exist in crypto but needs to exist, and it's the bond. A bond is simply a credit link that is transferable. And the blockchain, if it's made for anything, it's to represent assets and transfer them without intermediaries. And so in a sense, this is what we, whether it's us or any other competitor, need to recreate. Right now, there's a few tokenization platforms, but what they tend to do is just take your money, park it in where we say real world assets. Really, we're talking about US treasuries, and then you can't move it. Okay. You know, you can get in and out, but you can't take what you have, you can't take your token and send it elsewhere. And that's quite important actually, because assets such as treasuries, corporate bonds, they're not just about owning the asset, but they're also about using the asset, for instance, as collateral. And if you can't transfer your asset, then it's no good as collateral. And so that's the problem that us and I think a few others are trying to solve specifically.
So the main advantage is transparency and maybe efficiency also in the market?
Yeah. If it's on the blockchain, by design, it's transparent. That's what's nice. When something's on the blockchain, you get a lot of freebies without much effort. You know, and knowing who owns the stuff, you can see it in the smart contract. You know who owns the assets because it's on their addresses. Yeah. And in terms of the movement of those assets, it's also very easy to track. And
what did you choose, both of you, I mean, to create your own blockchain and not maybe to use something, I mean, bigger and...
You want to start? Yeah. Well, so first of all, we're going for Ethereum. That's the absolute elephant in the room. If you're not on Ethereum, I think it doesn't work. And in fact, there's a couple companies that do something similar to us, and they wanted to use things like Polygon and other for, I think, to limit fees. But I really think that when you get started, you got to go with the most widely used blockchains. So we're very blockchain agnostic. You know, if Avalanche takes over, we'll go on Avalanche. We'll go where client interest is strongest. But to begin with, we're just free riding on the security and wide availability of Ethereum.
Yacine?
For more or less of some of the same reasons, but for more or less of some of the same reason, but basically it's really resource consuming. There is no interest in creating your own blockchain or L1 or L2 if you don't want to create a whole ecosystem and you don't have like one or two products. It doesn't make sense. You're going to spend a lot of time recruiting, you're going to spend a lot of time building, and you're going to spend a lot of time like promoting it when basically what you want to do is just sell you one solutions. I mean, there is a lot of derivatives, one solutions, and then there is a lot of possibilities that you can do with that one solutions. But we just want to sell one solution, and we want to be blockchain agnostic, where we want to be able to go anywhere. It doesn't matter whether people need us. This is a decision that we can make. Okay, we're going to go there. We're going to do Ethereum, Avalanche, any of these L1s like BNB, whatever the case may be. If there is a clientele, if there is a need over there, we can just decide to just like launch in there and offer that solutions to the people that needs it.
Okay. Okay. And Arnaud, so for BPI France, you're managing billions of euros. I mean, how you see this space and how BPI France wants to be involved, especially maybe on issuing bonds on the blockchain in the next month or years?
We are involved in two ways, basically. We are a VC investor, so as a VC investor, we like to invest in blockchain companies if they are on the thesis which we consider to be attractive and sure in a way. Yeah. And then as a bank and as a financial institution, we have a strong belief that a part of the future relies in DeFi, and we don't want to miss this. It's not easy. It's not an easy play. For sure, a lot of asset classes do need more liquidity and more transparency. So what you guys are bringing to the market, you can think of private debt. You can even think of the bond market in general. It's not so transparent. You know, I issue, I think, 8 billion euros of bonds every year. Yeah. It's a struggle to know who is carrying my bonds. You know, I know it can be transferred, but I don't know to who. So if you ask me today, who's carrying your 40 billion euros of debt, frankly, I just don't know. And this is very frustrating, and I have to pay banks just to have a hint of who is doing that. So we can see the value, but to go from the current use cases to the massive use cases, on top of transparency and liquidity, you need trust. So we need to build trust. So we need a lot of regulation, a lot of compliance from all of these startups. And I know it's a common interest, but it's really a common work we need to do in the coming years. And we need scale. And scale, you don't get scale in a couple of years. Scale is not something you can decrete, so it's going to take time anyway. So the big question for me is, how do you reconcile those two worlds? Because what we see today are two worlds, the classical one, the DeFi one, and they almost don't talk to each other. So it's very interesting to see people rebuilding from scratch new infrastructures, and the rest of the market just looking at them, saying, okay, there's something happening, but how do I handle that? Very complicated. So for us, we try to find some use cases. For instance, we do a lot of private equity and venture, and we can see that tokenizing funds, private equity funds, venture funds, or tokenizing equity
which
titles.
Amounts? Yeah, on which amounts?
On which blockchain, you mean? Or
also blockchain, yeah, but which amounts?
Small amounts, to be frank.
Small
amounts, to be frank. Today, it's very experimental. Yep. But we are looking at retail investment as a new source of money for investment fund, for venture funds. And we can see that tokenizing will make it much more easier than we can do it without the blockchain today. It will be easier, more transparent for everyone tomorrow, but it will still be small amounts, a few €100 million probably. So it has to be small. If you look at the few bond issues which has been made by BNP or by EIB, it's also very experimental. And frankly, it's just to see if it's working. There's no interest today in doing this, apart from trying to see if you can manage the whole value chain front to back as an institution. But it's a start, and we have to start there, and we are willing to start there.
And what do you need? It's more about regulation, about maybe bigger infrastructure to go deeper in this space for BPI France or BNP and.
I think we as a financial institution, again, we need the right level of regulation. I need to convince my shareholders, I need to convince my board, I need to convince my compliance that I'm doing something right and that it's not going to blow up in 2 years. So it's a lot of internal work. I need the regulation to say, okay, I am compliant and this is dealt with. And then I need a lot of training from my staff, because you have to reinvent also all the jobs that are being done front to back. And third thing, I need a lot of open-mindedness from a lot of people because you cut a few jobs across the value chain, and you have to accept that. And I think that's where it's going to be difficult. You have never seen a massive innovation being fully carried by incumbents. So there's a big question of how you can trust banks to adopt blockchain massively one day, because you have frankly never seen that in any industry.
Okay.
So for me, the big interesting debate today is to know whether you guys are going to take the market one day, not tomorrow, but in 5 or 10 years, or if banks are going to be able to adopt something really new. Not that I don't trust banks, generally speaking. Obviously, I do trust them, but I've never seen incumbents doing this kind of pivot.
Yes. And actually, it's a good point. I mean, do you think that in the next years we will have the traditional finance and DeFi with, tokenized assets? So both of them, or we will have, a totally new infrastructure only on tokenized assets with no traditional finance. What do you think about this?
So it's going to happen in 2 steps. One, when you issue an asset, the asset is an asset for one side and it's a liability to the other. At the moment, within crypto, no one's interested in issuing liabilities because they know that they're not going to find takers.
Yeah.
If you said, actually, if you told me 6 months ago, well, CZ of Binance is going to tweet that he wants to borrow $1 billion, then probably just that promise, that tweet, would be 5 times oversubscribed. People would be throwing money at him. Even Binance today, I'm not quite sure that people would do that. So you take the most blue chip names in crypto, I don't think they would really find a broad swath of investors right now in their debt capital. So that's the reason why all the tokenization startups are doing US Treasuries. Because US Treasuries, you don't need to ask permission to buy them. You just buy them. You don't actually get the US government to issue them for you. You just go to the market and grab a hold of them. So that solves half of the equation. But the long game is not to do that. That's a little bit silly. And in fact, the only reason that it works is because buying US government bonds as an individual is a pain in the butt. It's really, really difficult to buy government bonds, as crazy as it sounds, at least as an individual, even if you have money. And so that's why people are doing that. But the end game is not to do that. The end game is to find issuers that want to issue digital bonds, digital debt. And that will live completely outside of parts of the financial infrastructure that we know today. And when I say the infrastructure, I really mean Euroclear, DTCC, Clearstream, the clearing firms. That's what we're really removing from the equation. And that's the long game. That system will only touch the traditional system at the margin if an issuer that issues against USDC wants to get actual dollars. Yes, they're going to have to find a way to convert the stablecoin into actual dollars. But that's going to be more or less it. And that's why I think the banks are really going to struggle with that. Because the banks want to do something that perfectly fits within existing regulation and are not willing to take any risk of that nature. And when you look at MiCA in Europe that's coming out, well, MiCA doesn't even address security tokens.
Yeah,
so you go back to MiFID.
For the moment.
Yeah, for the moment, yeah. But it's going to take a really, really long time. The market will have moved way ahead of where it is today by the time traditional institutions turn around and figure out they want to do something.
Okay. You, Yacine, what do you think about it?
Yeah, from a more, because I think you described like what's going to happen on a more like institutional level.
Yeah.
Within the crypto space, I think that at the moment and for the next 5 years, we still sit in a space where the DeFi ecosystem is, the opportunities that you get within the ecosystem are much more appealing than what you can get with the traditional finance at the moment. Education is going to be key, and we're going to have to bring enough value and easiness of use to rationalize the decisions to use traditional finance mechanism within the DeFi ecosystem. It's going to be super useful for a small portion of like what people are trying to do with their portfolio and money, it's not going to be valuable for a whole portfolio or wallet or people that wants to just manage like whatever they do with their money. They're never gonna do like throw like $100 million at like treasury funds and stuff like that, because yes, it is difficult to buy, it is not easy to use, it's a little bit like you need KYC, AML, all that stuff, and then there is other things that coming on the side, not talking about CBDC and all that stuff, but getting to a point where people within the DeFi ecosystem are educated enough within the traditional financial ecosystem so they can bet a small portion of their portfolio into a safer asset, that all of the degen stuff that they're doing on the side is where we're trying to go at the moment. But even within that, I don't think we are like, I don't know, at least 5 years removed from having like both of these worlds like colliding together. Like it's too far apart at the moment.
Okay, and Max, you talked about issuers. Do you have enough issuers on the market at the moment?
So people who want to borrow, you will always find them. But the investors have to be comfortable with them. And that's where we're not there. Right? So a lot of crypto funds are launching credit funds, credit-centric funds, to invest specifically in credit. I think one of the mistakes that were made is that the crypto funds invest in a broad range of strategies without a lot of differentiation and without siloing the different parts. And so a fund that would buy ICO tokens also put their money in Luna. Obviously, however well they did on the ICO token part of the business, they lost everything on Luna. And so I think now there's a real desire to get mandates to invest specifically in credit. But those funds are only getting started now. I think it's too soon in the crypto winter to find borrowers on the other side that they would be willing to vet. So yeah, we're gonna have to wait for that. Gonna be patient.
I have a slightly different view. It's a round table, so we're not supposed to agree 100%, right?
Yeah, for sure.
So I'm a bond issuer. As mentioned, I think the bond market is very inefficient. As a very credit-worthy issuer, at least very well-rated issuer, I'm very happy to issue a bond on the blockchain. The issue is there's no one to buy my bond. If I issue a classic bond, I have twice or 3 times the amount within 2 hours. If I try to issue on the blockchain today, there's no one investing, even in a AA bond. So the issue, to me, is not on the issuer side, but really on the buying side of the bonds. I agree there will be intermediaries in between that will, blow up, and so it's difficult. But really, I think the issue we have today is to find some buyers. And what I can see as an opportunity in the coming years is on the retail market, because a lot of private assets, private debt, private equity, even bonds are very difficult, as you both mentioned, to buy, even more as an individual. These are markets you can tackle, retail markets you can tackle with crypto if you can manage to tokenize even a simple bond or private debt or whatever. So I have a feeling, a sense that it will start with this and then, conquer the world or not. But awesome. I feel there's a more
shotgun. I want the business. Then you issue bonds. I'm gonna help you. Yeah. Let's do some business together. Then.
Right, let's talk after the roundtable.
Yeah. For private assets, I think that you're right. For treasury bonds like T-bills, it's a different story. I think that when people have the money and when the market is going to go into a place where there will be a lot of liquidity and the liquidity is going to try and go somewhere, then there will be a huge demand for that, because within the crypto ecosystem, people are just looking for efficiency. It doesn't matter what it is, they're looking for efficiency. If you can offer efficiency, and that can come with private equity, like when corporate bonds, somebody that offers like 10, 11%, with a maturity of like 2, 3, 4, 5 years, it depends on what it is. But if you can offer something like that on a consistent basis, and it actually makes sense, then yeah, there will be a huge demand. That's what we're betting on to be honest. But it's a little bit different. You have to be willing to go there. But people within the crypto ecosystem are risk takers enough. It's nothing to them. They don't care. They've been taking risks for it. But yeah.
Arnaud, you touched on something quite important actually, in that disagreement that we have here, which really isn't a disagreement, because our investors, shout out to them, they said when they were putting together the thesis that in their perspective, there were too many borrowers and not enough investors. And where I was coming from, I said there are too many investors, not enough borrowers. And the reason that I thought that is at B2C2, people thought that we're such a high quality firm that they were willing to lend to us under the rates for treasuries. So B2C2 borrowed hundreds of millions of dollars unsecured at 2.5% when treasuries were at 3.5%. It's crazy when you think about it. And so I came from a perspective of we need to create assets for those investors to invest in because there's a lack of asset. And now you're saying, well, I have the asset, but I can't find the investors. That speaks to, I don't want to call it an inefficiency, but something's not quite right in the mix if we're not able to meet in the middle in a market that at the end of the day, debt is as old as time. So it's quite puzzling that even an institution as big as yours you find it difficult to cross the chasm.
I agree. There's something weird, but it's so many years of doing the same business the same way. It's going to take time to get rid of that. But
And just how you explain this misfits between issuers and borrowers, and the fact that maybe it's different in Europe, whereas in the US it's more efficient. I don't know, Yacine, you're tokenizing T-bills.
So, I mean, it depends on how you want to do it. Obviously, do you want to buy on a primary market, secondary market? Like, how do you want to tokenize your bonds? There is so many models. That's the key point, right? Which models are you going to bring to the table? For example, for us, we are regulated in Liechtenstein, and we have a model that is like regulated by the central bank over there, which allow us to touch fiat and crypto, which allow us to be the middleman. That's how we're doing that. And we are selling only to people within the Euro space, Schengen space, and people in Asia too, because we are allowed to do it. But we are not selling in any case to people in the US. Like, we're not touching the US market.
Okay.
We're not allowed to do that. And we only acting from a regulated standpoint. Like, everything that we do, we're trying to be as textbook as possible and be on a constant talk with like regulators.
Okay.
And you get your answer right there. I mean, at least a partial answer. The market is, you have different pockets in different regions, and that's because of regulation. It's one thing to issue an asset, it's another to distribute it.
Yep.
So you may very well have an asset that is legal, but in order to distribute it in a certain country, you need to have a certain license. Different country, a different license. And the local requirements are such that no one really goes and try to replicate the same model all over the world. And there's a good company, Credix. They sort of nailed one pipeline between US investors down into Brazil. And they kind of nailed that. But in order for them to do the same thing, say in Singapore, completely different ball game. And so they're sticking to that one jurisdiction.
So the narrative of a world market is quite broken, right? I mean, it's quite hard to...
Yeah.
Okay.
There's no world market. I mean, what else you need to know? Everyone says, well, we're not touching the US. Either you say we're not touching the US, or you say we made a product that's bespoke just for the US, and essentially it only works in the US. So there's no world market indeed. And in fact, when you go back some decades ago, the emergence of the euro-dollar market, the euro-dollar market is the market for US debt outside of the US. And that emerged because on the regulatory front, you really had multiple tracks. And those two things were completely separate. And euro-dollar market became huge. I mean, LIBOR, which is the rate for banks to borrow in dollars, is set in London because of the emergence of that market separate from the US market itself, but denominated in dollars. And I think one of the challenges in tokenization, and maybe, I'm trying to watch what I say because I know there might be journalists in the room, is that what do you want to achieve as a company? Do you want to have a beautiful, perfect product that no one wants and you die a slow death? Or do you want to be the next Binance? I reckon if Binance paid a $10 billion fine, still worth it if you're CZ. And so the challenge is going to be to create something that looks more like a world market. Why? Because if it's on the blockchain, you can't really stop it.
Yep.
So once you put assets on the blockchain, there's the possibility, not necessarily going to happen, but the possibility of the asset going into, I mean, if you want to be cynical, the hands of North Koreans, but also the hands of legitimate dentists in America and, accountants in Europe. And that's where you want to go. Of course, you need to put a bit of a framework around that so that it's not just a free-for-all. But because the rules are so different And the infrastructure is so different across the world, it's impossible to have a world market for assets in TradFi. And that's what we're trying to do, but it does entail taking a little bit of regulatory risk and going where others either do not dare to go, or to operate in that area where you don't know what the rules are yet.
And you all operating in Europe, how you see the market? I mean, do you think that Europe is forward on tokenization, especially on assets?
Well, I mean, Europe is a conservative continent when it comes to financial services. So that's a negative. On the other hand, the rules are nice here. They're more clear than in other places.
Yep.
And you've got 500 million Europeans. So I think there's some pros, there's some cons.
Yeah, I would say that in many ways, the good thing in Europe is that you know where you stand because it's very precise, but at the same time, you don't have the same liberty in order to exercise business. Yep. When you're talking about the US, it's much more of a gray area, which allows business to expand and become like billion-dollar companies. And usually when you grow to that point, this is where the problems actually, I mean, the SEC is coming for you, all of that we've seen lately, even with companies that are theirs. Like we're talking about Coinbase, they basically validated their own stablecoin 3 years ago, and now they're going for them. I mean, what it doesn't fit their narratives, the law is always gray enough in order for them to take it back if they want to. Europe is a little bit different. You don't have as much freedom, but you're more or less guaranteed that you're not going to have those kind of problems if you become like the entity that takes the space in the market. That's the difference between those two areas where, in terms of business.
Yeah. And do you think, Arnaud,
I think it's a bit of a paradoxical time because we are used to, to see the US ahead of Europe, and we had this discussion just before.
Yeah.
Right at this point in time, we have a sort of a feeling that we may go ahead of the US because they are so strong on, clamping down on big crypto companies. So we have the right regulation, we have very good technologies. It's an area where it's easy to build a pan-European company too, which is very important, or a global company, because as you mentioned, once you have put the assets on the blockchain, then it's global. So we have an edge, I think, as Europeans, thanks to the regulations, thanks to the goodwill of a lot of governments, and thanks to the strength of our engineers and developers. I just hope we are not missing something. Seeing the US, being so tough right now, I think they have missed things in the past which we didn't miss. And I think we have to go down the road finding the right way between, regulating, which is a historic strength of Europe, let's say, let's put it this way, but not too much of it, and the right way. So clarity, simplicity, but strictness in regulation. I hope we can achieve this balance. So far, so good, I would say.
Yeah, Europe is ahead. You love to see it.
Yeah, it's great, actually. It's almost hard to believe.
We'll see how long it takes, though, because usually, like the sets of rules that is set is not so bad. It's actually usually better than in the US. The problem is that it takes 10 years.
Yeah, and there's always this question of do you do the business and then regulate, or do the regulation and then do the business. We know it works one way in the US, the other way around in Europe. So far, so good for Europe, but it's still very open.
And what's the main challenge for, MIMO or PV01? To step up, to gain more and more traction on the market?
One of the challenges is that dial between being aggressive, especially when it comes to, I would say, selling restrictions, and how close you want to fly to offering your product to retail. That's the holy grail. In fact, it's funny, at B2C2, we'd always say, yeah, we're an institutional business, as if that's better. It's not. When you say, oh, we're just institutional only, it doesn't mean that you're more prestigious or something like that, or operationally more advanced. It just means you're lazy. You're too lazy to do the hard work of getting the right permissions to interact with the retail. And so I think the challenge for a lot of tokenization companies is, how am I going to get my assets into the hands of retail in a way that's legal and that's not going to lead me to be fined hundreds of millions of dollars in 5 years?
But maybe you need to start with big players, maybe like BPI France and other institutions, and after you will see, I mean, yeah, a big market on the retail side, maybe, no?
For sure, but in crypto, the entire market is
Yep.
driven by retail interest. I mean, name one project that had an institutional-only focus that really took off. They don't exist, right? I mean,
Oh no, I mean you have some like the data analyst Kaiko. I mean you have some projects.
what does Kaiko do?
Yeah,
right?
yeah.
Like,
Actually,
they sell data to
Yeah.
institutions, probably B2C to the client, I don't know, or they take data from B2C
Yep.
too. But they do that so that those intermediaries
Yep.
can serve, in the end, retail in the market.
Yeah.
I mean, you look at what's one of, maybe, I don't know, the biggest client at B2C2 might be Robinhood. What does Robinhood do? Yeah, they don't do fancy algo trading, and if they did, it would just simply be on the back of that retail interest that Robinhood, in the end,
yeah,
is
at the end,
generating.
yeah. At the end, you're right. You have retailers, but maybe you can't. I mean, go directly to them on the first end, and you need obviously
course.
to go through.
Of course,
Okay.
of course. And this, I think this is also one reason. One reason crypto is so popular is because for once you have a business where you feel like, as a retail participant, you have access to some things. Of course, some of those things can burn your fingers, but you do have access to those things, which is really not the case in traditional finance. I mean, the first rule of a prospectus for a bond is minimum size has to be 100,000 euros. 100,000 euros. I wonder what percent of the population that excludes. 99%? 99.5?
Yeah, sure. Yeah, sure. Yes.
I think there is two big sets of challenges for us. The first is finding a good model, getting it approved, finding a jurisdiction in where you want to actually like exercise business, getting regulated, so getting a license or the approval to do business. All of those regulatory challenges are like majors. Like it takes like 1 to 2 years if you are being very efficient to get to that point. That's 50% of the equation. The other 50% is education, because you need to get people to a point where they actually understand the value of what you are bringing to the table, because those two worlds have been so inert in their own ways that they don't really understand like what the other side of the shore is actually like bringing. Our role is to sit in the middle and to say that there is actually a need for both of them. There is a need for both of them. Yes, we are pro blockchain and we want everything to be in there. Like a blockchain technology is what we're vouching for, and that's what we support 1,000%. But there is certain things that we can take from the other side. We can bring them here and we can make them better. And we can actually be more efficient and more transparent for it. If you can bring a product that actually gives you the trust that you would have in a traditional bank, because they are like custodian and have all of the credentials to do it within the blockchain ecosystem, and brings you the transparency of the blockchain ecosystem, then you have like an actual product that improves what we always had in finance within the blockchain ecosystem. And those are the challenges, and those are the things that you are trying to bring within a new ecosystem that is growing like day in and day out. Just make it better and more efficient. But it doesn't mean that we have to be more risky or more degen or more. We just want to have some of it that stay within a reasonable realm where you can be confident that you can leave your money there and it's just going to grow and it's going to be safe and you're going to be able to do all of your other stuff like on the other side of the shore.
Okay,
Yeah.
okay, interesting. And you, Arnaud, so could you work with DGens and Web3, I mean, tokenized?
Sorry,
Yeah.
I can't even hear you actually.
Oh, sorry. No, I mean, so for you, what's the main challenge, especially on these topics in the next years?
In the next years, I
Yes.
think all these companies in the crypto world should not forget that I think basically what we are building is the trust infrastructure of the future. It's trust for the DeFi, so for the financial system. It's also trust in terms of authenticity in the food value chain, trust of authenticity in the green energy chain, trust of authenticity in the world of the web with generative AI, etc. So basically, I think the real potential of blockchain is building the new trust infrastructure. And it's absolutely important, absolutely critical in the world we're going to live in. And it's absolutely complicated to do. And we have this luck, which you mentioned, Max, which is that we have this crazy money coming from the retail market and coming from this kind of crazy interest in crypto money, which is probably maybe something that will last, maybe not. I'm not so sure about that. But I'm sure it's providing the money to build this infrastructure. And I think we should bear that in mind. And there is a road which is potential because there is this money flowing in today. And we have this view that there are so many critical things to build with the blockchain in the world of tomorrow. So
okay, perfect. We have 5 minutes left. If you have any question, feel free to ask them. The first one is always the hardest, but go ahead. Nobody?
Too warm.
Yeah, it's too warm, yeah. I'm sure that you have many questions. Okay, go ahead.
Thanks. Maybe a question for you, Max. How do you see the product that you are launching in comparison to stable coins? Because they could potentially be used in the same way. Is that also one of your ambitions?
Great question. Here's the dynamic between tokenized assets and stablecoins. So stablecoins by design cannot pay interest because if they pay interest, they become securities. That's essentially the problem of stablecoins. And also the benefit because that means the interest is captured by the sponsor. That's the business model. Now, when you tokenize an asset on a stablecoin, you actually decrease the float of the stablecoin, which is quite interesting when you think about it. So very mechanically, if you take your USDC, send it to us or another provider, and you want to tokenize US treasuries with that, the USDC are converted into US dollars in order to buy the treasuries. And so there's a redemption there that decreases the float of USDC in the system, which is quite interesting because it means that instead of Circle or Coinbase capturing the interest, suddenly you're just using USDC as a payment rail, kind of what it was supposed to be from the beginning, and then the interest goes back to the person who's actually owning the USDC. It's quite interesting, and I'm not quite sure that the stablecoin foundations have realized that yet, because they seem to be quite supportive of those endeavors. I imagine they think that there's also a war in terms of competitive dynamics between stablecoin issuers in the sense of having as many assets and apps in their ecosystem. But it is quite clear to me that when you tokenize assets and they're purchased with stablecoins, that does lead to a decrease in the float of stablecoins because economically it's not possible that both the stablecoin issuer and the owner of the stablecoin get paid interest. Otherwise that's double counting, right? It's one or the other. I think the only way for us to end up with a system where tokenized assets don't lead to or I guess digital bonds don't lead to a decrease in stablecoin float is that the issuers themselves have to keep the stablecoin as is. They have to just borrow in stablecoin, keep the stablecoin, and then use the stablecoin for payments, buy a factory, what have you. But as soon as you turn the stablecoin into something that touches yields in the real world, meaning in the fiat world, then the stablecoins disappear and we're essentially only used for the payment itself. So there's a bit of a conflict there, an economic conflict between the foundations and the issuers of digital assets.
Okay, thank you very much. I see that Christophe and the team is here. So thank you guys for this panel. I hope you enjoyed it and see you after.